Now, you can have 10 accounts and then and have a certain amount that has to come out of all 10 and take it all out of one. That's fine. But you have to take out that amount or they penalize you 50% of what you should have taken out. And then you got to pay tax on that too. There are some exceptions to that they've introduced also. Let's say, so the answer to most questions is that it depends, right? I haven't gotten to use that one yet, but from the look on your face, it looks like it might be applicable. So, and here's the, like I said, we'll send you these if you want, but like for us, Brittany and Angela and I, we'll have to be 73. For some of you, that'll be 70 and a half, which is where it used to be a couple of years ago until they changed it. Any questions about this? Okay, here we go. Now, here's the surprise. Well, one surprise. They like to break this out on you. So this tax rate, and this should be 73, but it's old. It starts at 3.7% or so, which may not seem like a lot, but on 100 grand, every 100 grand, that's $3,700 that you have to pull out. Now, is that awful? No, not necessarily. It depends, right? It's only awful if it pushes you up into a higher tax bracket than you want to be, i.e. outside of zero, or if it causes your Social Security to be taxed. Then it can be awful, and we'll look at that too, right? So this number goes up to 16% when you're 100. Now, is 100 worth even looking at? The answer is yes. But does anybody know what the average life expectancy of an American is this last year, 2024? Including infant mortality, it's 79 and a half. It's not bad. I mean, we can do better, but that's not bad. So there's a reasonable expectation that some of us in this room will live to be 100, right? And the IRS knows this as well. So they've got their bean counters. Are there any actuaries in here? Okay, they've got their bean counters going all the time. Yeah, I mean actuaries, right? And they're very good at their job. So they've set up life expectancy tables. They know they have the whole matrix all set up. Matrix, did I say that too? Okay, so anyway, the point is this amount increases every year. But here's the rub. Social Security Social Security income also increases every year. The thresholds that you meet for taxation haven't changed in a very, very long time. And we'll see more of that later, but actually we're about to get into it. So here's the rule of thumb for investing in your tax deferred accounts. And there are some projections involved too, like Excel is our friend with this situation. When you have a 401k, the best for us, our best recommendation is that you contribute up to the match, whatever your company matches, if they do. And then beyond that, put it into an IRA where we can work with it because we'll make you more than your company will, most likely. And I feel 99% confident saying that because we can. So, and if they don't match, then we can look at setting you up an IRA that will probably make you more than if you contribute to your 401k. I'm not saying don't contribute to your 401k. I'm saying contribute up to the match if they do it, and then look for better ways to take the tax deduction, but also contribute to a tax deferred account. As long as your balance isn't too high. And we'll get to that in a minute. So you want your balance. So does anybody know what standard deduction is for a married couple in 2025? No. I think it's 30 this year. Has it gone up? Oh, it's 32. Standard deduction, yeah, for your taxable income. Last I saw it was 30, but so you're saying 32?
It's close to that.
It's close. What's your name?
Jerry.
Jerry says it's 32. So if it's wrong, it's Jerry. No, I'm just kidding. So, they made it so you can't afford, so it doesn't make sense. That's right. So whether it's 30 or 32, the answer to this question is, so when you turn 73, and this is a little bit of backwards math, and it tends to throw people off, and that's okay. When you get 73, Hey, happy birthday. So Leslie says she's going to be 73 and she gets good service from the IRS. You are lucky. Okay, you'll find out. So here's the deal. When you have to take that 3.7% out of all these accounts right here, you want that number to be low enough that your standard deduction covers it. Now, you actually want it to be even a little bit lower than that because of Social Security income. We'll get into that a little more also. But you want that number to be lower than your standard deduction. As a matter of fact, I can't. What's your name? Norm the Prophet. Check it out. No. So let's say this is Leslie. She just turned 73. Her standard deduction is 30,000. So the question is how much money can you have in your IRA, in your tax deferred accounts at 73? So when you pull 3.77% out of there, if your balance is 500,000 in all of these accounts, then you're going to have to pull out $18,850, right? So as long as that is below this, and given Social Security, you want a buffer in there, so you want it considerably lower. I'll say that. How much depends on what your balance is and what your Social Security is. We'll get to that in a minute. So let's say this is your 401k and you've been what they call a good girl, and we're going to look at a couple at an example. You've been a good girl and done what you should have the whole way, right? Which is throw money into your 401k, which is what a lot of people will tell you, and it's not entirely wrong unless it is, right? So if your balance is 500,000 and this year, and you have to start taking out 3.77% and then going up from there, then you'll have to pull out $18,850 from this account. And anything that you pull out of this account is now taxable, right? So if this is all you have to pull out of a taxable account or tax deferred account, that's all of your taxable income, right? Does that make sense? So if that's all that you pull out, then that's all you have, that's taxable income, leaving out Social Security, right? So then you're only going to pay taxes on that, but your standard deduction is 30,000. So this comes off of your standard deduction, right? So you're left with about $11,000 of taxable income before you start getting taxed, right? And yes, Norm. It comes out of that standard deductions. Exactly, right. So now you have some room to put Social Security income in there for planning purposes so that you don't necessarily get taxed on that or taxed as much, right? Does that make sense? Okay. Is there anything you would like me to elaborate on for this? Because I want to make sure we get this, because this is the basis of retirement planning right here, this slide. Yeah. Yes, it can come from any of them, but so if your balance is 500,000 across all of them, then that's got to come out from somewhere, right? And it can come out of one. It doesn't have to come out of all of them individually, right? Okay. Is that clear as mud? Swim.
So we don't have to worry about this until we're 70. We have to take it out.
This part, right? You don't have to take it out till you're 73, and I won't say worry necessarily unless you like to worry, but I will say it is worth thinking about and planning to avoid. Actually, that's why we're here. We're here to help you with that. We're here to help educate you on how to do that and what to do that and why you should, and then we're also here to help you do that if you want with us, and or work with your advisor, or accountant, or whoever else you want us to work with. Like, we're more than willing to do that. So we're not just here to get clients, by the way, just so you know. Having said that, we don't mind having you as a client if you want to work with us. Okay. If you don't ask the question, the answer is always no, right? Yes. What's your name? Nancy. Okay.
So, as a married couple, you're both over 73.
Yes.
So
Uh,
Or is it-
everything. So that's a good question. We get this a lot. Can my husband be on my Roth IRA or my IRA? Can my husband be on my 401k? Can we have a joint account? The answer is no. And the reason is because your social security numbers are tagged and tracked, and all the income that ever goes in there and all the income that ever comes out is tied to your individual number, right? So if you turn 73, 1 year and you turn 73 the next, it'll double the next, or it's both of you, right? But if you're both 73, then you both got to do it individually, but jointly if you're filing jointly. Does that answer your question? Oh.
Then what is that?
Right. Then you get, and we also work that into planning too. And as it turns out, there's a favorable age gap between people. Like if you're 10, 15 years apart, a lot of people look at that as a negative, but for planning purposes, it's like a dream, honestly, because, well, there are just things that have to happen at a certain age that don't have to happen at another age, right? So anyway, that's just me nerding out as an advisor for you. Okay, so the ideal balance to have in your tax deferred accounts, and if you're 50, you want to look down the road to when you're 73 and check your rates of return and see what it's doing, because it will grow presumably, right? As long as it doesn't get cut in half and have to start over again. We'll talk more about that later too. So what's the ideal balance to have in this bucket when you're 73? Just generally speaking. It's not a particular number, but it's a number to what you have. Yeah, go ahead. No, go ahead. You're right. Yeah. So the number is your requirement minimum distributions are less than your standard deduction, and by a buffer, depending on your Social Security income. Right? That's critical. Yeah. Yeah, less than 30,000. You're gonna want a buffer in there too, depending on what your Social Security is. So yes, there are some that do. Yes.
I mean, I just turned 74.
What's your name? Yeah, what's your name?
Yeah.
Pam. I think Pam has a brilliant idea, and we need to email the White House and see if they can put it. Actually, there's talk about not taxing Social Security at all, and I don't know if it's going to work. It would be nice to see things potentially rearranged for that to work, depending on how they actually shake out. I don't know, but it would be nice to see us not pay tax on taxed money again. Yeah. Well, anyway, I'm sure we all have an opinion on that one. And I'll bet it'd be similar if we asked. Okay, so there are investments that claim to be tax advantaged. Oh yeah, okay. So does anybody know why there's this frog in here? What'd you say? Leslie. Give this lady a gold star. The frog, y'all familiar with the frog in the pot, right? This is the frog in the pot right here. If you put a frog in boiling water, it'll jump out. If you put a frog in lukewarm water and turn the heat up, it will boil to death. That's turn up slowly, right? I know it's an awful analogy, but Leslie nailed it. You want to come up here and do this? Listen, there are lots of, out of the 80 million taxpayers in the U.S., there are lots of frogs, and they like it that way because it makes them more money. So that's kind of why we're here, is to help people step off the tracks, as it were. Okay, so the tax advantage bucket, or tax free. Guess which bucket's my favorite? And it's about to be yours. Okay, so there are some investments that claim to be tax free. We talked a little bit about this already. They have to pass these tests. They're free from all taxes, and they don't cause your Social Security to be taxed. Muni bonds and oil and gas, you pay capital gains on those and or other taxes. So they are good investments if you need them for your portfolio where they are, but they're not really tax free or tax advantaged completely, I'll say. So the advantage of these is super obvious. It does not generate a 1099, and it does not cause your Social Security to be taxed. Those are the two things that you do not want. Now, what do we have for examples of these? Roth, anything that says Roth on it, Roth IRA, Roth 401k, Roth conversions, which is where you take some money from this bucket and you move it into this bucket. You pay taxes on it for that year that you do it, and now it's in your Roth IRA. It's in your Roth IRA, and you own it for life, tax-free, as long as you follow the rules. Two rules that the IRS has about a Roth IRA. One is that the gains have to sit there for 5 years, then they stay tax-free. And you can't take out the gains till you're 59 and a half plus, or you get taxed on them. So other than that, so any money that you put into a Roth IRA is liquid, meaning it's yours, meaning it makes a great savings account, right? Because you've already paid the taxes on it. So you put that money in there, and then you let it sit and grow. And what they end up taxing you, or what they end up forgiving the taxes on after 5 years and 59 and a half is the gains, right? So if you put in 8,000, you can take out 8,000 the next day if you want to. It's not always advisable, but if you need it, you can take it. What else do we have? Yes, sir. Norm. That is correct. And if you're going to do that, it's to your benefit to do it in stages, or do it all at once if you have no income to claim, and depending on what the amount is. Like, it depends, right? So we look at your whole situation and how that one piece fits into the rest of your situation and what your needs are, right? The gains, yes. Yeah, so if you put 8,000 into your Roth, and then let's say we're making somewhere between, say conservatively, we're making people about 18% in our market accounts. So let's say you put in 1,000, and then you make $180. You can pull that 1,000 out anytime you want. But if that $180 sits there for 5 years, then it also becomes tax-free. It's pretty cool. That's a Roth IRA, right? Now, Jim, it depends. Actually, you're in my head. You're where I was going next. If you do Roth conversions, there's no limit on how much you can convert from this bucket to your Roth IRA in any given year. Around 2010, I think they changed that. There used to be a limit. Now, for a contribution, which is different than a conversion, a contribution has limits of 7,000 if you're less than 50 and 8,000 a year if you're over 50, depending on how much you make. And there's actually there's a phase out schedule is what they call it. So if you make over a certain amount and you're a single filer, and